All right, everybody, welcome back. You are now here in Mr. Ray's Wealth Academy. Heavy on the Mister, baby. And this is episode 5, and we're going to continue our series. And the title says it all, baby, how to pick the right stocks. Because we know every stock does not belong in your portfolio, and every stock does not fit the wheel. So we talked about through episodes 1 through 4, we showed you how the wheel works. Today, I'm going to show you which stocks fit in the wheel, okay? That's phase 2. This is practical application. Let's get started. All right, so let's dive in. But before we dive in, we got to go back and we got to set the foundation, baby. Everything we do here is built on kingdom principles, baby. 4 pillars. Ownership. God owns it all. We're stewards. We're simply responsible to manage it wisely. And then at the end of the day, baby, there's an accountability. We got to answer for it. And if you're faithful, the Bible says that you're going to get a steward's reward. And there's going to be more opportunity for you. So that's the framework. Let's apply it to stock selection. All right, quick recap. Phase 1 is done, baby. We've been there. We did episodes 1 through 4. You learned about what options were. We talked about the wheel strategy. We introduced you to cash secured puts. And then we also did covered calls. So now we got to talk about phase 2, which is the practical application. So I gave you the knowledge, but now I got to give you wisdom, baby. I got to show you how to apply this thing. All right. And so that's what we're going to do right now. We're going to talk about stock selections. And that is, you need to know which stocks are going to fit and which ones don't fit in the wheel, baby. All right. And then I'm going to take you through some platforms. Then we're going to do some live trading. All right, let's get it. All right, here it is, baby. This is the core of everything. This is the golden rule, baby. Before you do any wheel, before you select any stock, you got to ask yourself this question. Would I be happy owning this stock for a full year? Not for a day, not for a month, for a full year. Because with the wheel, you might have to hold it that long. When you sell a put and you get a sign, you own it, baby. Now you're selling covered calls. Maybe you hold it through multiple cycles. Okay. So if the answer is no, if you don't want to own this thing for a year, I need you to move on, baby. Don't force it. That's the golden rule. Why it matters? Because you might have to own this stock. So we're only going to be looking at stocks that we want to really own, but we want to own them at a discount. All right, here we go. Now, assuming that you've selected a stock, it's past the golden rule, baby. You want to own it and you're okay with owning it for a year. Let's talk about the first factor, liquidity, baby. This is the lifeblood of options. All right. 3 things. There's volume, and when I say volume, that means, are people trading this contract? Is there lots of volume? That means if there's lots of volume, there's a lot of people getting in and out, baby. And that means that it has a lot of open interest. That is the total number of contracts that are out there. That tells you if traders care about this strike price, right? Or if it's ghost town. If it's not anybody trading it, that's not something you want to trade. You want something that people are getting in and out of, so it's going to be easy for you to trade, all right? The bid ask spread, that's the gap between what buyers are willing to pay and what sellers want, baby. You want that tight. You want a spread that is good, a wide spread. You lose money just getting in if it's too wide. You want tight spreads, okay? Liquidity means the ability to get in and out without bleeding cash on a bad pricing, baby. That is critical. All right, so let's talk about factor number 2, implied volatility, IV. Think of it like a heat meter. If it's too high of an IV, that means danger zone, baby. That means the stock is very volatile and it's very, very unpredictable. It can go up 40 today and down 20 tomorrow. Yeah, the premiums are going to look juicy and they're going to be high because it's got so much volatility. But the risk is real, baby. If you don't set the right strike price, baby, you can get blown away. Or if IV is too low, it's too boring. The stock is stable, the premiums are tiny, it's not worth your time, baby. You're not even earning a percentage point on it. What you need to find is the sweet spot right in the middle, baby. That's where it's got good income, but it also has manageable risk. Stocks that have the real price movement, but not crazy. That's where you want to be, baby. And how do you find that? Well, you're going to find that out in episode 6 when we get to the platform. But for now, the sweet spot is in what your target needs to be. I call it the Goldilocks, baby. It's not too hot, it's not too cold, it's just right. The Goldilocks IV, baby. All right, factor number 3. Now, this is not one of the most important factors, but it is a factor. This is what I call the bonus, baby, sir bonus. Some stocks pay dividends. They've been around a long time. They make a lot of money, so they pay their shareholders back in dividends. I mean, we will look at stocks to pay dividends, but if a stock doesn't pay dividend and it's got the right premium, baby, it's in the Goldilocks, we'll still go there. So think about it. You sell a put, you collect the premium, you get assigned. Now you own the stock. Now, in addition to owning the stock pays a dividend. And then when you sell a covered call, you collect more premium. And if you're long on the stock long enough, you'll collect another dividend. Now look at the numbers on the slide. Without covered calls, you can get a 5.6% return. With covered calls, you can get a 7.1% return. That's not magic, baby. That's called layered income. Premium on top of premium, and the top of that, dividend. Come on, baby. Dividend paying stocks are especially good in the will. They're not required, but they're a nice bonus. But what you'll find out a lot of times, there's not a lot of volatility around these stocks because they pay a dividend. Of course. So now, Mr. Ray, you've talked to me a little bit about IV. I need to pick good stocks. Okay, so where do I find these good stocks? Okay, so first place you're going to start is you're going to have to determine what sectors you want to look at, right? And so I'll tell you the ones that work best for me, right? I like blue chip. I like Apple, Microsoft, Google. They're very liquid. They got strong premiums. They got a lot of volatility around them, but you might not have an appetite for that, right? Maybe you like to go with like healthcare, stable. They got good premiums, but they pay dividends also. What about financials? JP Morgan, Bank of America. They got high dividends and consistent IV. You might go to the energy sector, okay? High yields, but they're very cyclical. You know, gas is up, gas is down. And then you can do risks. You can do Vanguard. You can, there's just a multiplicity of areas that you can go into, right? And you just have to get comfortable with what works for you. Consumer staples, huh? Procter and Gamble, Coca-Cola, stable, dividend, boring stocks. These sectors have a lot of liquidity and the IV you need. So you just need to pick what area that you want to focus in. Again, me, I'm tech blue. I'm in the text, baby. That's what I do. All right, let's talk about what stocks we want to avoid. Here's some red flags. First of all, you got penny stocks. All right, no liquidity and options. You'll get crushed trying to get out because you it's so small. There's just not enough action there, not enough liquidity that you can get in and out of it, baby. And then you have meme stocks, huh? G Game, AMC. These were people out here buying back and forth because they think they're gonna get rich, baby. It's the get rich quick scheme. Yeah, the volatility is high, the premiums are huge, but the risk is real. That stock may be trading at 30 today and it may be a penny tomorrow. Stocks can crater overnight. And then third, pre-earnings play. Don't buy stocks and don't put them in the wheel during the earnings week. It's too much going on, baby. The IV will spike when you buy it, and then it'll tank afterwards, and you'll get hammered, baby. And then fourth, no options, liquidity at all. That means the volume is too low and open interest is zero. I'm gonna need you to avoid that. You can't exit, baby. And then fifth, companies you don't understand. If you can't explain what they do, if you don't know what products they offer, you don't know what sector they in, you don't want to will them, baby. You need to understand the business and evaluate your risk accordingly. All right, so here's my checklist. Before you will any stock, I need you to answer these 6 questions. Okay. Number one, would you be happy owning this stock for a year? Not only that, I'm going to go a step further. You want to own this stock and you want to own it at a discount. So if it passes that and you be happy with owning it for a year, baby, then it's a good deal. Number two, does it have liquidity, baby? Is there high volatility? Are there tight bid and ask, baby? I need to make sure that people are getting in and out of this stock so when I want to sell it, I can get out of it, baby. If there's no liquidity, there's not going to be any buyers and sellers. And then that IV, babe, I need to make sure it's in the sweet spot. I need to make sure it's not too hot, not too cold, just right. I need that Goldilocks IV, baby. That's what we're looking for. And then, do I understand what this company actually do? I even know this company? If I don't know what the company does, if I don't know what it sells, if I don't know what it serves, is it a good company? If you don't know anything about the company, why you even bother getting involved with it, baby? Come on now. And then am I okay with it getting called away at my strike price? Right? So when you set a strike price and you got a call option out there, then you got to be willing to let it go at that price. Okay? Don't fall in love with them stocks, baby. Fall in love with them premiums. Okay, now an added one, does it pay a dividend? That's just a bonus layer, not a big deal to me if it doesn't. All right, now let me show you an example. Let's use a stock that you may or may not be aware of. It's JP Morgan Chase. The ticker is JPM. Is it a will candidate? Okay, let's walk through the checklist and see. First of all, we're going to ask, would you be okay with owning it for a year? Yeah, it's a blue chip stock. It's a strong company, good long term income coming in, great balance sheet, been around for a long time. No problem. Passes that test. What about liquidity? Well, looks like the volume is 500 plus contracts a day. The bid ask spread is tight. All right, that's a good deal. So it passes that. What about IV? The IV is around 25, not crazy volatile, but it's not boring either, right? And then, do I understand the business? Well, it's pretty easy. It's a bank. They lend money, they manage assets. Okay? Am I going to be okay if I get it called away? Yes, a strong company, happy to sell it at a profit, baby. Does it pay dividends? Again, that's added. Yeah, they pay like 2% yield. What's the verdict? JPM is a solid will candidate. Let's go, baby. All right, so let's recap what we learned today, baby. We talked about the golden rule, number one. Would you mind owning this stock for a year? If you do, that's great. That's your candidate. Is liquidity good? Liquidity is everything, baby. IV, is it in the sweet spot? The Goldilocks? Good balance? Then it's a good candidate. What about dividends? That's just a bonus layer, baby. But I also need you to avoid the red flag. And I need you to use my 6 point checklist to avoid those stocks. These are fundamentals of stock selection. And these, if you get these right, then you're gonna be setting yourself up for success, baby. Let's get this. Okay, so now you know which stocks to pick, baby. But knowing is only half of the battle because in the next episode, episode 6, we're gonna really get practical, baby. I'm gonna be walking you through some of the platforms out there: Robinhood, Fidelity, Vanguard. Where do you find your stocks? How do you check IV? Where do you place your first real trades, baby? We're gonna get practical. That's episode 6. Now I need you to do something for me. I need you to subscribe and hit that bell, baby. I'm Mr. Ray, heavy on the mister. Let's build and grow and prosper this thing together. All right, so I got to put the disclaimer in, baby. This content is for educational purposes only. It does not constitute financial advice. Option trading involves significant risk and is not suitable for all investors. Always do your own research, consult your licensed financial advisor before you make any decision. And also, past performance does not guarantee future results. Mr. Ray's Wealth Academy does not provide personalized financial investment recommendations, baby.